Welcome everyone. Today we're going to dive deep into a fundamental area of financial analysis, the income statement. This learning module is your gateway to understanding a company's performance, and it's crucial for anyone preparing for the CFA Level 1 exam. We'll cover everything from revenue recognition to earnings per share, EPS, all while making sure it's relatable and easy to understand. Think of this as a journey through the income statement, where we'll break down complex concepts into manageable pieces, just like you would in a real-world financial analysis. Revenue is recognized when it's both realized and earned. For instance, if a company delivers goods on credit, they'll recognize revenue when the goods are delivered, not when payment is received. At the time of delivery, an asset is created. This could be an account receivable. When the payment is eventually received, the company will increase its cash balance and decrease the account receivable. Conversely, if a company receives cash in advance of delivering a product or service, this creates a liability called unearned revenue. The company doesn't recognize this as revenue until the product or service has been delivered. For example, think of a magazine subscription. The publisher receives payment upfront, but only recognizes revenue as each issue is delivered. Accounting standards for revenue recognition. In May 2014, the IASB and FASB issued converged standards that emphasize a principles-based approach to revenue recognition. This involves a 5-step process. Identify the contracts with a customer. This step involves determining whether a contract exists, which is essentially an agreement between two parties with commercial substance. For a contract to be valid under IFRS, it's probable that the company will collect the consideration. Identify the performance obligations in the contract. Performance obligations are promises within a contract to transfer distinct goods or services. A good or service is considered distinct if it can be used independently or with other readily available resources. Each distinct obligation must be accounted for separately. Determine the transaction price. This is the total amount the company expects to receive in exchange for fulfilling the contract. The transaction price may include fixed amounts, variable considerations, or even discounts. Allocate the transaction price to the performance obligations in the contract. Once the transaction price is determined, it's allocated to each performance obligation based on their relative standalone selling prices. Recognize revenue when or as the entity satisfies a performance obligation. Revenue is recognized as the performance obligation is satisfied, which means the customer gains control of the promised goods or services. For example, consider a software company that sells a bundle including software and future updates. The company must allocate part of the transaction price to the software and the remainder to future updates. Revenue from the software is recognized when it's delivered, but revenue for the updates is recognized over time as they're provided. Now, what happens when there's a change in a contract? The Converge standard provides guidance on this too. If a contract modification introduces goods or services that are distinct from those already provided, it's treated as a new contract. However, if the goods or services are not distinct, it's considered a modification of the existing contract. Let's look at an example. Suppose Builder Co. originally has a contract worth $1 million with a bonus of $200,000 for timely completion. Later, they agree to modify the contract by changing the floor plan, which increases the contract price by $150,000. The builder expects their costs will increase by $120,000 due to this modification. Revenue recognition will now be based on the new total costs and the progress toward completion. Moving on to expenses, these are defined by the IASB as decreases in economic benefits during the accounting period in the form of outflows or depletions of assets, or increases in liabilities that result in a decrease in equity, excluding distributions to equity participants. The matching principle is central to expense recognition. This principle states that expenses should be recognized in the same period as the revenue they help generate. For instance, if you purchase inventory in the third quarter and sell it in the fourth, the cost of goods sold should be recognized in the fourth quarter, aligning with the revenue from the sale. Sometimes firms must estimate expenses to ensure proper matching, such as bad debt expense or warranty expense. For example, if a company sells a product with a warranty, it must estimate the future warranty costs and recognize them as an expense in the period of the sale, even though the actual cost might be incurred in a later period. Expenses can be categorized into period costs and product costs. Period costs are not directly tied to revenue generation and are expensed in the period they're incurred, like administrative expenses. Period costs also include depreciation of long-term assets, which is the allocation of an asset's cost over its useful life. Alternative inventory costing methods. There are several ways to account for inventory costs. Specific identification method. This method tracks the actual cost of each specific item, which is practical only for businesses that sell a limited variety of high-cost items, like a car dealership. FIFO, first in, first out. Under FIFO, the earliest purchased goods are sold first, so the ending inventory consists of the most recently purchased goods. This method is beneficial during times of inflation as it results in higher net income and higher inventory values. Weighted average cost. Here, the cost of goods available for sale is averaged out, which smooths out price fluctuations. This method works well when inventory items are indistinguishable from one another. LIFO, last in, first out. LIFO assumes that the most recent purchases are sold first. This method, permitted under US GAAP but not IFRS, results in lower net income during periods of rising prices. Due to higher cost of goods sold, but it also lowers tax liabilities. Capitalization versus expensing. All right, class, now we're going to tackle an important concept in financial reporting, capitalization versus expensing. This is a key area that can really change how we view a company's financial statements. So let's break it down. What's the difference? Let's start with the basics. When a company spends money, it has two choices: capitalize the cost or expense it immediately. Capitalization means treating the cost as an asset. This asset then sits on the balance sheet and is depreciated or amortized over time. Essentially, the company is spreading the cost over multiple periods. This approach increases profitability in the short term because the cost is spread out over several periods. For example, if a company spends $100,000 on new machinery, it doesn't expense the entire $100,000 immediately. Instead, it capitalizes the amount, showing it as an asset and depreciating it over the machine's useful life. In the period the expenditure is capitalized, this will result in higher assets on the balance sheet, lower operating cash flow, and higher investing cash flow. Let's dive into what happens when a company decides to capitalize an expenditure rather than expense it. Picture this. When a cost gets capitalized, it's not just shuffled around in the books. It shows up as an investing cash outflow right on the statement of cash flows. What does this mean? It means you'll see more cash flowing out under investment activities and less under operating activities. Now here's the kicker. Because these costs are moved out of the operations section, the cash flow from operations looks beefier. Yeah, it appears higher than if you just expense the cost right off the bat. This isn't just a small detail, it's super crucial for understanding how a business is handling its money, and it can totally sway how investors and analysts view the company's financial health. Expensing means the entire cost hits the income statement right away, reducing net income for that period. No spreading it out. Boom, it's all there at once. If the expenditure is expensed immediately, it hits the income statement all at once, reducing net income for that period. For example, if the same company decided to expense the $100,000 machinery cost in the year of purchase, it would see a lower net income in that year, but it wouldn't have depreciation costs in the following years. Over the life of an asset, the total net income will be identical whether the company capitalizes or expenses the cost. The difference lies in the timing of the expense recognition. Effects of capitalization. Now, when a company capitalizes a cost, a few things happen. Assets go up. The cost is recorded as an asset, boosting the company's balance sheet. Cash flow shifts. The expenditure shows up as an investing cash outflow, not an operating one. This can make the company's operations look more profitable because those operating cash flows aren't taking a hit. Higher profits initially. Since the cost is spread out over time, the hit to net income is smaller in the period the cost is capitalized. This boosts profitability metrics like ROA, return on assets, and ROE, return on equity. Lower leverage. With more assets and equity on the balance sheet, leverage ratios like debt to equity drop, making the company look less risky. But there's a catch. As time goes on, that capitalized cost needs to be depreciated or amortized. Each period, a chunk of that asset is expensed, which reduces net income and the asset's value. So while you get a short-term boost, profitability in later years might take a hit. Also, remember, not all assets are depreciated. Land, for instance, is not depreciated, and intangible assets with indefinite lives aren't amortized. These stay on the balance sheet at their full value unless there's an impairment. Now let's flip the coin and look at expensing. No new assets. The entire cost hits the income statement immediately, so you don't see an increase in assets. Net income drops. Because the full cost is recognized up front, net income takes a hit. This also lowers retained earnings on the balance sheet. Lower initial profitability. Metrics like ROA and ROE are lower in the year of the expense because the income statement is carrying the full burden of the cost. No depreciation later. The upside? No depreciation or amortization in future periods. This can lead to higher profitability down the line since you won't have those ongoing expenses dragging down net income. Interestingly, this approach might make a company look less profitable in the short term, but it can create a perception of stronger growth and higher profitability in later periods. Why it matters. Here's the kicker. Over the life of an asset, total net income will be the same whether a company capitalizes or expenses the cost. The difference is in the timing. Capitalizing spreads the cost out, giving a smoother profit trend, while expensing gives a one-time hit with potential for higher profits later. As analysts, we need to be mindful of this. Companies might capitalize to boost current profits, but that can affect how we view their performance over time. Always consider the motivations behind these decisions. capitalization of interest costs. Now, a quick word on interest costs, especially for long-term projects. When a company borrows money to build something like a factory, the interest on that loan can be capitalized. This adds to the asset's cost on the balance sheet and is then depreciated along with the asset. But if the project is for resale, that capitalized interest becomes part of inventory and gets expensed as part of the cost of sales. Accounting differences. Here's a tricky part. US GAAP and IFRS treat interest expenses differently. Under US GAAP, interest is usually an operating cash outflow, while IFRS allows it to be either operating or financing. This difference can affect cash flow comparisons between companies using different standards. When assessing a company's ability to pay its debt, the interest coverage ratio, we need to consider both the capitalized and expensed interest. Adjusting for these can give a more accurate picture of the company's financial health. Remember, adjusting the denominator for capitalized interest usually lowers the interest coverage ratio, which is what credit rating agencies look at. Finally, let's touch on the costs of developing intangible assets like software. Generally, these costs are expensed, but there are exceptions, especially in research and development, R&D. IFRS allows development costs to be capitalized if certain criteria are met, while research costs must be expensed. US GAAP usually requires both research and development costs to be expensed, but there's a twist. Some software development costs can be capitalized after the product's feasibility is established. When you're analyzing a company, you might need to make adjustments to account for how these costs are treated. Adjust the income statement, balance sheet, and cash flow statement to get a clearer picture of the company's true financial performance. So, what's the bottom line? Whether a company capitalizes or expenses costs can have a significant impact on its financial statements. As future CFA charter holders, you need to dig deep, understand these decisions, and adjust your analysis accordingly. This knowledge will help you see beyond the numbers and understand the real story behind a company's financial health. Let's talk about non-recurring and non-operating items. These items are separated from continuing operations because they are not expected to occur regularly. A discontinued operation refers to a segment of the business that the company has decided to sell or shut down. Under both IFRS and US GAAP, these operations are reported separately in the income statement. This helps analysts make better predictions about future earnings, as discontinued operations will not contribute to future income or cash flow. The key point here is that the discontinued operations must be operationally and physically separable from the rest of the company. Unusual or infrequent items, these are items that don't happen often but are significant enough to impact a company's financial performance. Examples include restructuring charges or gains and losses from the sale of assets. They are reported as part of continuing operations but are disclosed separately. For example, if a company sells a factory at a significant loss, this would be reported separately under unusual or infrequent items. Analysts need to consider whether these items are likely to reoccur when making future projections. Now, let's discuss changes in accounting policies, estimates, and errors. This is crucial because it directly affects how we analyze and interpret a company's financial statements. First, let's talk about changes in accounting policies. This happens when a company switches from one accounting method to another, like moving from FIFO to LIFO. When this change occurs, it's applied retrospectively. This means the company goes back and restates previous financial statements to reflect the new method, ensuring consistency and comparability over time. This way, when we compare financials across different periods, we're looking at data that's been adjusted to the same standard. Next, we have changes in accounting estimates. These are adjustments made when new information becomes available, affecting things like the useful life of assets or expected bad debts. Unlike policy changes, these are applied prospectively, meaning they only affect current and future periods. No need to go back and restate the past. Companies disclose significant changes in estimates in the financial statement notes. While these don't impact cash flows, they can have a big effect on net income. So as analysts, we need to pay attention to these disclosures. Then there are corrections of errors. If a company discovers a mistake in previous financial statements, it must correct this retrospectively, similar to a change in accounting policy. This ensures accuracy and reliability in financial reporting. Frequent errors might indicate deeper issues within the company's accounting systems, so they're worth scrutinizing. Finally, consider changes in scope and exchange rates. When a company acquires another, it consolidates financials, which can complicate comparisons with previous years. Additionally, exchange rate fluctuations can distort the income statements of multinational companies. While not always required, companies often provide summary information to clarify these impacts. Now onto earnings per share, EPS, one of the most closely watched metrics in financial analysis. EPS measures the amount of profit attributable to each share of common stock. Simple versus complex capital structure. A company with a simple capital structure has only common shares outstanding, making EPS calculations straightforward. But when a company has convertible securities like bonds or preferred stock, the capital structure is considered complex, and you need to calculate both basic EPS and diluted EPS. Basic EPS. This is calculated by dividing net income available to common shareholders by the weighted average number of common shares outstanding during the period. Diluted EPS accounts for the impact of convertible securities, stock options, and warrants that could potentially dilute the earnings available to common shareholders. It's always equal to or less than basic EPS. Okay, let's talk about if converted method. When calculating diluted EPS for convertible securities, you assume the conversion happens at the start of the period. For convertible bonds, you add back the after-tax interest expense to the numerator and increase the denominator by the number of shares that would be issued upon conversion. Now onto treasury stock method. For stock options and warrants, you use the treasury stock method. You assume the company uses the proceeds from the exercise of options to buy back shares at the average market price. The difference between the new shares issued and the shares repurchased is added to the denominator in the EPS calculation. Finally, let's look at two key tools for analyzing income statements: common size analysis and income statement ratios. In common size analysis, every item on the income statement is expressed as a percentage of sales. This approach makes it easier to compare companies of different sizes or to track performance over time. For instance, if you notice that one company has a higher gross profit margin than its peers, it might indicate that the company is selling a differentiated product at a premium price. Now let's talk about income statement ratios. Some important ratios include net profit margin. This ratio measures how much of each dollar of revenue turns into profit. A higher net profit margin indicates better profitability. Gross profit margin. This ratio looks at how much of each dollar of revenue is left after accounting for the cost of goods sold. It's a key indicator of a company's pricing strategy and cost control. Operating profit margin. This ratio reflects the efficiency of a company's operations, showing how much profit is generated from core business activities before taxes and interest. By the end of this analysis, you'll have a solid understanding of a company's profitability and financial health. These tools are essential for comparing different companies or assessing a company's performance over time. And that's a wrap. We've covered a lot today, everything from the nitty-gritty of revenue and expense recognition to the complexities of earnings per share and the nuances of income statement analysis. As future CFA charter holders, you'll need to master these concepts to excel in your exams and in your professional life. Remember, the income statement isn't just a report, it's a story about a company's financial journey. Understanding this story will help you make better investment decisions and provide more insightful analysis. So keep practicing, keep questioning, and most importantly, keep learning.